All right, this is Ken Long from Tortoise Capital with the chat number 3. So we're looking into the week ahead for the Swing Trade Workshop, Advanced Swing Trading for February 15th, 2016. This is the agenda that we'll follow. And the recording, I'll get that posted and hang a link for you if you need to listen to the stuff again. So I want to cover some introductory remarks. Take a look at the homework that we worked on this week and just make some general observations and ask if you have any questions on any of that stuff. I'm going to cover the homework review for next week, things that are due by Sunday. To stay on pace, and then I'll talk briefly about the videos to watch for the week ahead as well. So the first thing I want to say is the emotional state exercise. That was an opportunity exercise that really made sense to me on the basis of things that occurred in the chat room, some commentary, and so put together a quick exercise to get to the fundamental psychological elements of what we're trying to do, the difference between the left-hand side and the right-hand side, the left-hand emotional, impulsive, unintentional side of our trading, the emotional response to stimuli, and the right-hand side, which was the measured response after a period of reflection followed by professional action, with the idea being that thick line in the middle between those two stacks of words that I asked you to put together to characterize the feelings and what was going on, that line in the middle really does represent our edge in the market, that we are able to separate ourselves from herd behavior, that we can act mindfully in the market, and that everything that we do in terms of planning, preparation, and execution, our processes, our checklists, or getting our mind right, all of that is designed to keep us on the right-hand side of that wall. It made me think of the Great Wall of China, or defensive perimeter, or thick skin, or the walls of a monastery. All of the things that are designed to allow us to create the space within us to act in a way that is we know to be positive and beneficial. And I was really impressed with the work that you guys did on that. It seemed like it resonated with quite a lot of you, and I read all of the contributions there in the files area and the message boards, and it seemed like it resonated pretty well. I'm pretty happy with that as a practical exercise for keeping us mindful of what it is that we're trying to do. I mean, the whole purpose of going through all this stuff is so that we don't act like herd animals in times of maximum stress. And so whatever that happens to be for you, whether, if you're a kinesthetic person, you need to clap your hands or put a rubber band around your wrist, and then when you feel the onset of stress and impulsive behavior coming, you snap that rubber band so that you get shocked into mindful awareness, whether it's a song or an image. We need some way to get recentered or getting back to the zero state. So I think if you take a look at the work you did on the zero state exercise and that emotional state exercise, you'll realize that they're really heads and tails of the same coin, that we want to be able to diagnose where it is we want to be. We want to trade from a place that we know to be effective for us. And we talked last week about how that could move us in different locations on that grid. Some of us could have different optimal areas. There's nothing that says you must stop one particular way. So the emotional state exercise was really a battle drill for how to go from a moment when you realize that you're acting impulsively or you're off your zero state, you're off center, and how can you rapidly get into that zero state. So I think if you found that exercise to be useful, the process that you went through to work through those emotions and to generate the new emotional state, we're going to find some way that you can trigger that as a ritual so that you don't have to formally do that every time you notice yourself off-center. Find some way that you can quickly get into that new state. I think of it as battle stations for me, or getting to stand to. In battle stations, you think about the bridge of the Star Trek Enterprise, and when they go to yellow alert and red alert and people are in battle stations, everybody is geared up, ship's at maximum readiness, and everybody's leaning forward properly and professionally and ready to go. And so in the Army, when we think about preparing to move, going from a state of rest to a place of higher readiness, ready to march at a moment's notice, we call that stand to. And we say, all right, everybody stand to, and that has a specific definition. Everybody's gear is packed, you're alert, you're facing out, you're scanning your sector, you're ready for marching orders in a moment. And I think that's what we've got to do in order to be ready to go from just generally stalking to focusing on a target and planning our raid, or planning the kill, or planning the trade. So I would ask you to think about that in your learning journal and in through your experience, and talk with your partner about what kinds of things might you do that helps you rapidly achieve that state of readiness. That simpler is better. I'd like you to think through that one if you would. The second thing, some supplemental videos. I just finished recording today on the basis of some requests, some additional videos that really would go into last week's lesson about market classification, market models, and statistics. You see them listed down at the bottom. I'm going to have the links posted into this week's list of videos to watch, but there'll be supplementals, so if you want to watch them, you can. They're fairly short, 3 to 5 minutes, but it talks a little bit more about market classification, the basis for using it, and what we can expect from it, and it just extends the remarks that I make in that info paper. And then there's one on useful mental models to start thinking about this top-down approach that I recommend and that I personally use, where I start with the market classification first, move to sectors, and then move to individual stocks if needed, and why that holds together, and what some of the supporting mental models look like for that, and then a short discussion on the standard use of formatting in my reports for statistics and what the basis of that is. So those will be hung up shortly. So you can look forward to those. I want to shift a little bit to the market and sector theme analysis homework for this week, and a new worksheet that I built for you. So what I asked you to do for this week was to listen to last week's market report review, or the weekend report review, and then just listen for the things that I was saying about conditions of the market and conditions of sectors as a way to start identifying potential trade ideas, or swing trade relationships. And I'm going to ask you to do that each week as part of putting together your trading plan for the week ahead. And what I asked you to do was to listen for me to make an assertion about something. Like I might say, I think I did say something like, we're in bear volatile conditions, and so therefore we should be reluctant to take long side trades. We should shorten up our time horizon and be prepared to exploit large intraday ranges, and only take swing positions when we have earned market's money to put at risk because of the tendency of the market to go down during bear volatile conditions. And even if you go short on swing trades in a bear market, we got to recognize that because of the increased volatility, that the possibility of large adverse moves against our short are also in there. So that might be an assertion you heard me make. And then I would ask you to write that down, in the second column, The third column was what was the indicator I was using to make that claim. And then the fourth thing would be now take a look back at the themes you heard me identify from last week's report, and then what actually transpired this week. I think you would find that that advice from last week was generally pretty good, that there was not much follow through to the upside in the market this week. Continued weakness and testing of that lower low, and we're still in a posture that could go sharply in either direction. So in my view, a shorter term time horizon is advised. So this week I would like you to do the same thing with the new report that I hung yesterday and analyzed. And so I want to just share with you a worksheet I put together and hung in the files section to maybe assist with that analysis. Robert properly points out that biggest days of all time have come almost exclusively in bear markets. The sharp buying at the bottom that is intended to punish the shorts and make them regret that decision. So that's another reason I don't like to go short overnight, is because I don't want to be on the wrong side of that. Let me see if I can find that worksheet for you here. There we go. Okay, so this is the worksheet that's in your files section, and this is geared towards the same sequence in which I normally cover them. And so let me get the laser pointer here. So the way I would use this form, you may find this easier, is to start on page 2 of the daily, listen to my discussion of the risk Z and the market classification, and if I say anything about it, go ahead and note that in here. If you're working kind of at the level 1, and we talked about that last week, level 1 analysis, where you're listening for the things that I say and documenting those, and then in that 4-column worksheet talking about the results, and then shift into pages 3 and 4, where I talk about the gap statistics and the swing system signals and comments about the RSI2 and 10-day NDX and whatnot. These are all the detailed reports, the tactical summaries of the Dow 30 and the ETF 30, where I comment about different trends and signals that I see, and then working your way through that report. In level 1, listening to the things I say and documenting, and then at the end of the week, checking out what actually happened. Level 2 is where you would take a look at the report yourself, make your annotations, and then compare what you wrote to the commentary I make to see if I say anything that you didn't see, or if you saw things that I didn't say. And then that becomes the basis of checking your readings of the report against mine, and gives us the basis for some additional questions. Hey, Ken, I saw this. I saw the indicator and I thought it was this, but you said that, and that doesn't square up with my understanding, or what led you to that conclusion. And then in the dialogue, it's like iron sharpens iron. We'll both work on improving our reading of the reports. And then in level 3, you're essentially just reading the reports yourself for those indicators that make sense to you and that which you see a way to exploit in a way that is satisfying with the systems you like. And now you've graduated into using the reports in a way that is tailored specifically to your desire. So what we want to do here in these weeks ahead is to have you work through levels 1, 2, and 3 so that you can internalize the processes and procedures on the basis of evidence that you've accumulated over these next 10 weeks or so. So that's the main idea. So this file is hanging in the files section on Basecamp, and I would invite you to give it a try if you think that will help. And so I've got all the different things that I look at. Now, if there's a number in this column, in that first column, it means it's on the daily report on that page. If there's something that is starred, like it says RLCO framework and continuations and the VolStat. Well, those are things that are not found in the daily report, but which, when you look at the at charts and that we use, you may see some of those. So a continuation play would be nothing more than a swing trade from earlier that's still open. Shows you an opportunity to do some reward to risk framing, and then allows you to set up another trade or to inform how you want to manage that trade. The daily report also includes the market health check, where I'm talking really about the trends and patterns that I see in SPY. It's the additional form that I send out with the daily report. And then these last three here in the weeklies, these are just ways of looking at the things that only change once a week as a way to identify potential swings, opportunities, or swing relationships, looking at the holdings in the blended monthly rebalancing, what the allocation percentages and what the rankings suggest from the report. The same with ETF2, and then commentary that I make on the world market model when I'm trying to look for broad global trends. So this worksheet, I'm hoping, may help you to start to develop proficiency in reading and understanding and thinking about the reports. These are all elements of a market mosaic. There's no better way I can put it than that's Robert has been calling it for years. And each of these is a little piece of the overall pie. It's a different part of the elephant, if you will. It gives us a better insight into what might be going on and what might be tradable. So I offer that technique and worksheet for you. If you got any questions on that one, just go ahead and chunk them into the questions. Otherwise, I'm going to go ahead and move on. I really want to encourage you to keep using the message threads for crosstalk and questioning. I think that's really going well. You can see when you log into the Basecamp if there was any activity and on what day it last occurred, and that way you can kind of quickly go right to the things that changed. And it's much preferred to do it that way than email, because this is a chance to create some documents and an archive for your fellow students and me to work with. We're not trying to chase our email tail. There's a complete package of things that are then available for us to comment on. I'd encourage you to look at the comments even outside your own work group. If you work with your partner online, asynchronously, those message threads are really a nice way to keep the conversation going, and creates a narrative thread that other folks can join and follow. So I'm getting a lot of valuable insights out of those, and I try to comment on it where I can. So let me just continue to encourage you to use that. Catherine has graciously taken on the large challenge of doing a couple things for us. The first one is she's assembling what we're calling a book of forms. As we start building new worksheets or process checklists, and I'll give you just use the example of the one I just showed you, the market and sector analysis worksheet. She's going to put all those into a workbook for us and call it the book of forms. And then the second thing she's going to do is get our arms wrapped around all the readings, the writings, the videos, the exercises, and get them organized as you see here on the main screen. We're going to just put some codes and link them up with lessons and then a task number. So like HW0201 is review the info paper on the market classification. So she's going to get all this stuff organized in that way so we can create a workbook as a takeaway for you guys to keep all this stuff organized. I personally find it relatively easy to work online. I'm used to doing it that way. But I also appreciate other folks would rather have maybe a more structured approach to the material and go through the stuff step by step. Plus, I'm throwing this stuff at you pretty fast. It's a fire hose. I always worry about under-delivering, so I try to give you more stuff rather than less, and that's just my own limitation. and insecurity, I suppose. But this is a way that if you find yourself being overcome by the material, this gives you a structured way to work at your own pace. And I don't want you to get discouraged if it's coming too fast or too hard. Just I'm going to try to maintain this weekly pace so that we can generate the product, and then you will have permanent access to this material, and we'll get all the recordings on thumb drives and whatnot, and the resource workbooks. So we're going to try to bring a little more structure to the lessons as we go. But this is the pilot program for this, and so we're blazing some new trails through the snow. And so if you see things that would help or videos you'd like to hear me make, please let me know so that I can add to the resources and make this to be of more value to you. So that's what I want to say about the workbook and the book of forms. I want to kind of move on through the homework review, and these were the things that I asked you to do this week. To review the IP on market classification. The supplemental video that I will hang here shortly talks about that in a little greater detail, about the methodology we used and the justification for paying attention to it. There is a video on the risk Z and also some summary slides from Tim's work on the research weekend in there. And there's a video on risk Z as applied to the swing. This week, asked you to get your trading journals started and trade logs started. Now, you probably have not taken paper trades yet, but wanted you to get them organized and ready to go, because in either this week or next week, I would expect we're going to get to get some swing trades started. And again, asked you to analyze last week's report for market and sector themes. Maybe on the message board, talk with your partner about how that went for you, share some insights on the procedure, and really start looking at how you might structure your signals for the week ahead, or your trading plan for the week ahead based on those themes. Is that some way to help you decide which swing trade signals you might want to take? And that's basically how I do it. You guys asked me in the master list of tasks to cover for the course, how do you decide when to take or not to take some signals on the basis of market and sector conditions? Well, my general answer to that is by going through the market and sector analysis, I start getting a feel for what the broad themes are, and if it's a particularly dangerous time for long side trading like it is now, because we're in a bear volatile, then I'm going to use that to override maybe some swings. I may not take every long side trade on the swing that fires, because remember the 5DD and the washout pattern work to the long side in bears. Well, if we're in bear volatile, I may not want to take 10 of those trades if I get 10 signals. Maybe I want to take the top 2 or 3 on the basis of reward to risk. And I might be ready to play the failure patterns on them in the bear volatile. Or I may say, look, I'm not going to take the long side at all, but I'm going to frame the trade and then only take the failure trade. Well, that's a legitimate position to take too. So in general, I use these market and sector analyses to help me sift through all of the signals and then make a managerial decision about how much risk I want to take and then which signals I am going to prefer. And a lot of it just has to do with what is the nature of the target. If I like the 5DD, which I do, and if the volatility ETF is in that 5DD, and that's my favorite target, then that's going to be my high priority trade, because it's a signal that I like with a target that I like in a market condition that's very favorable for that. Robert, the info paper on market classification is in the files section, and then it's also in the swing trade page on tortoisecapital.net. The video your action learning journal. Ask you to take a look at that one. That's, to me, an important one because we are really engaged in action learning in this workshop. That we're trying to find a personal blend of theory and practice, documenting it, what we think, what we do, what results we got, and use that to feed forward into the next round of action. So I want you to get into that mindset, and then I strongly recommend the use of the learning journal to help you get organized in that way. Let me shift now to the homework review for the week ahead. This week we're shifting, week 1 was information about self. Week number 2, or I should say week number 1 was introduction. Week 2 was on self. Week 3 was on the market conditions. And now we're getting ready to shift into the systems area. And so the homework for this week is the rule sets for the 6 swing systems: channeling, overreaction, triple screen, 5-day down, 551W, and washout. And then listening or reviewing the task number 2 is looking at the videos where I go through and hit the highlights and give you my narrative. Now, I just finished uploading the channeling video, and I tried to use highlights of the rules, some sample charts for setup, some longer-term pictures of what the typical trades are, and then a review of the summary stats as a way to give you an overview of that system. So my intention is that between the video and the narrative, I think you should be able to get your arms around that system. And so this week's task is to read the system descriptions, listen to the videos. There's a bunch of trade case studies on the Swing Trade homepage at Tortoise Capital for you to look at too if you want to see some of those trades in action. And then to generate specific questions about those systems for me to clarify. So that's really, this week is intended to get your arms around the written definitions of these systems. Okay. I think it's still probably premature to expect getting 1 swing trade frame per week done, but if that's a stretch goal, so if you if we do get some signals this week when you look at the daily, or if there's a trade you want to frame based on your understanding of that one of those system definitions, go ahead and post one in the chat room and see if you get it right, and you'll get some feedback from the folks in the room and from us, and we can get that done. Then if you close one out this week, go ahead and post a trade case study in the Swing Trade room, so we can start looking at that as a sample of a case study. And then the weekly trading plan for I should say week 4, excuse me. There we go. So the trading plan prepared for week 4 based on the weekend report for February 13th. And what I should say on that is that's the analysis of the market and the sectors based on my reading of the reports. Videos for us to watch this week. There is a morning trading plan script. I think I want you to start getting familiarized with that. That is that's a script that Charles Howard is using with great effect to organize and focus himself in the chat room. It's the morning script that we use during the live trading workshop for both day and swing trading. It's a way to distill all of the prep work down to an executable format. It's sort of your elevator speech for how you want to trade that day or that week ahead. And so I'd like you to start looking at that and see what that looks like. The channeling video is already up. I will have the other ones completed and uploaded shortly by this time tomorrow. And then there's a link for the weekend report review for February 14th for you to do the market and sector analysis. Start, that'll be your second week of doing that. And then I will have the I just haven't posted the links to the market classification, mental models, and statistics. I'll get The videos are done. They haven't finished uploading to YouTube yet. So that's what the week ahead looks like. This week is there's a lot of work in there to get down to the detailed level. So what I need to know by around Thursday or Friday is about where you are on getting those things done. And so if we need to defer next week's work by another week so you can just get those 6 done, then I'm good with that. I mean, I can go ahead and start preparing materials ahead of time. But if we need to do a second week to get the systems definitions down, I'm prepared to do that, because I think this is really getting to the fundamental lessons of this workshop, is to really get a deep understanding of the systems first. I think you got to do that before you get into the strategies. I think it's important to be grounded in the set of mechanically tradable systems. So this is an ambitious list of things to do this week. Just keep me posted as you and your partner work through it. If we need a second week to keep everybody together on this one, then I'm fine with doing that. So that's we're about 40 minutes into the discussion here, so I want to really turn it over to you guys to see if there's any specific questions that you would like me to address before I clean up the battlefield here with some other things. Yep. Stan, have you listened to the videos on Risk Z? Couldn't find them. Yeah. Okay, go to the right board that has YouTube's. There's a right board that lists the videos. Let me show you where that is. All right, so when you go into Basecamp to the Swing Trading Online Workshop, you should see this page. And then go down to the very last one here. So I'm clicking on right boards. Go down to the YouTube links, watch them by the date indicated. And then inside, I didn't label it separately. This one here, it says Market Classification 2. That has the Risk Z inside that. I will get that relabeled. It could be why we couldn't find it, because it didn't have it labeled properly. There's also in the Files section I thought we had one in there. We have Tim's worksheet on Risk Z summary. Yeah, on page 2 of the files, this one, HW0202. This one here has the Risk Z summary applied to swing trading. So I'm going to actually open that one up and talk about it, because it's a good one. Yeah, so this is the this page here is, I think, the key takeaway from Tim's work. So the Risk Z is computed by comparing a fast-moving average and a slow-moving average to the risk index. Right? We take the value of the 10 period and the 30 period VIX. And in normal conditions, the longer term moving average, it has a higher value than the 10 period, because under normal conditions volatility is declining. There are periods, short periods, when volatility gets dramatically increased, and then the short-term VIX reading is higher than the long-term risk. That's abnormal. What happens is when that level of fear and panic can no longer be maintained, the volatility starts to drain, and at some point the short-term volatility declines enough that it falls below the longer-term moving average, and that's the normal condition. So this histogram simply shows that reading, much like a MACD histogram. And when there's a lot of fear and loathing in the market, this histogram will turn red, and it will spike down to a point where it gets as steep as it can be. When it starts to roll up, much like a MACD histogram does, this becomes, in region 1, a chance to start building initial positions on swing trades. In region 2, which is where it's now less than 1 standard deviation below zero line and all the way up to the peak of this hill, this is prime time for swing trading in this region. Let me get the spotlight on it. This is prime time for swing trading in region 2. If it gets beyond 1 standard deviation above the zero line, which is this horizontal line here, this is a time to start being very careful to manage your exits and your stops properly. Up around region 3, you should be concerned that maybe the move is more over than not, and you're closer to the end, so be careful about adding too much new risk. When it starts rolling over, this is where you're really managing your trades, not taking a lot of new trades unless you've got markets money, and sitting on your hands. In region 6, you can be looking for relative strength leaders, or if you're so inclined, this is where I like to, this is prime area for me to be intraday trading on the short side and really piling on. And this whole idea is similar to this notion of the business cycle that you see indicated right there. So that's the main idea behind it. It's a MACD histogram, but it's really based on volatility rather than on price. And so Tim's presentation from last year at the research weekend looked at things this way. These were the results of swing trades that he did, and then mapped it to the conditions of the risk Z. And the bottom line, in the bottom part of the graph here, you see this was price levels in the S&P, and his attendance in Kansas City was right here in the middle of this graph. And so the first set of swing trades he did, he was applying this thing religiously, and he made 16R from this, where region 1 becomes region 2, all the way up to the peak. He tried some swing trades after it started rolling over, and he netted about minus 0.7. I'm sorry. This was minus 0.7. There was some chopping around here where he did not ratchet back his risk size, and he was staying too long, and he was minus 11R. He was able to squeeze out 4R once it peaked and went down in here. So this was after Kansas City May, so he was varying his targets. The targets he was using here were those things that actually do pretty well in periods of increasing volatility, like defensive plays and using VXX. So the difference is, instead of losing 11R under that condition, this time he's actually able to make R when the market is volatile by shifting his targets and planning accordingly. And then he was able to make 8.5R going from region 1 to 2 to 3. He reduced a lot of his losses in here on this downside. Again, this I think was the still trying too long on the long side and not taking advantage of this steep, sharp moves downward. And so this is where he's learning now to maybe sit on his hands more, is his current conclusion. And then when the peak drop-off occurred in here, he's able to get on the correct side of the market and declining volatility to correspond with this monster move out of the depths here. So you can see before and after that by tuning his understanding of risk Z, his swing trading dramatically improved. With nothing to say about the intraday as well, but just the difference between before and after, and a deeper understanding of risk Z really served him well. I think there may be one more chart in here. Yeah, and so it basically gets to the point where volatility is really a market condition. And so by looking at the risk Z early and often, that helps you appreciate what's going on in the market condition. If you get that right, that's about 50% of the battle. And then focus only then on the sectors and the individual companies. And so his learning point on all this was that he's developed his own set of specific rules for how he wants to apply the risk Z, but modifying like the numbers of positions and the amount risk as a basis of what season volatility is in based on risk Z. So it's not just the setup of a particular symbol on a chart, but he's taking into account market conditions for volatility as well. So that's what I'd like to say about that. Dave asked me, can we use the S&P daily true range 30 and 10-day moving averages instead of the VIX? I would not. I can't really say yes to that because I haven't done the research. The reason to use the VIX is because of some academic literature that had studied this in general. Now, they weren't looking necessarily at one-day trades or swing trades, but these were guys in the Journal of Applied Finance that had studied the 10-day versus the 30-day moving average of the VIX, and were trying to draw conclusions for much longer-term performances. And I've sort of developed this into I think a practical tool to apply that gives us a particular advantage just on the basis of volatility. Now, long-term, there is a good correlation between volatility. It's an inverse correlation between volatility and price performance. But the problem with that correlation is that when you look at really long-term stuff, you lose some of the insights that are available in the fat tails. That when the volatility regime shifts, you can actually start looking towards the long side much sooner, even though the volatility is still high. The fact that it's declining actually suggests that that you can start looking at the long side sooner than just waiting for price to recover. So the volatility is an early tell in market direction, or front running some changes in the market. Using the daily true range as a measure of volatility in the 10-day moving average. The other thing I would say that's fairly similar to that, to what you're suggesting, is what I call the Slopestat, and this is I covered a little bit of this in the market classification discussion, but it bears repeating. Let me see if I can find that rascal. All right, so this is on page 7 of the daily report. What I would just draw your attention to the slope statistic on this page in here. So in the upper left-hand quadrant, chart number 1, the 30-day regression line, that's the last 30 days of the S&P. The blue line is the straight line 30-day regression. This black line is a polynomial regression line that is a little more adaptive than the straight line regression. It's almost like momentum of the slope of the 30. I'm still toying around with this. I don't know any specific rules yet, but what I would tell you is the fact that when it got very steep and then price started to improve in here, the polynomial said, hey, there's a potential that this thing's going to get really well. It didn't follow through from where the red dot was, it just failed for the next 6 or 7 days. There was no smooth bottom here like a bowl. It just failed. And you can see that by now the polynomial has come back and joined the 30. And it says the market right now is still very vulnerable at this double bottom. There's only 1 day of pop in this thing from Friday. So this is a market that is really still very, very vulnerable. So that's the current condition. Now let's take a look at the slope statistic. The slope statistic now is if we take the slope of this line, the straight line from today, and we plot it down here, we see that's what this moving blue line is. This curvy blue line is the actual time series of the slope of the 30-day regression line. Now we go back on chart number 2 over here. So this is the last 180 days of that slope statistic. And I want you to notice that the black line is the 10-day moving average of that slope. And when it crosses its own 10-day moving average at a distance more than 1 standard deviation away from the long-term average, then you have a potential turning point in the market that you would be well advised to pay attention to. So the last 3 times it's done that, this one after the big sell-off in August last year, there was a really nice move. This was about a 15% move off the bottom, and the Slopestat gave us a very smooth and clear path all the way up. I mean, that's pretty well tuned to avoid the noise, right? And then it got 2 standard deviations above the long-term average. So the long-term average is this black line. And so it went from -2 sigma to +2 sigma, and then couldn't get any steeper upwards, and then started to roll over. So here it is crossing its own 10-period moving average to the downside. This was a warning to us early that the gains that were made in here are no longer easily available. That's about as much as that market can move before it has to take a pause. And so it started to decay all the way down to the 0 line, which is this dotted line. When it comes back to the dotted line, that means the 30-day moving average, or the 30-period regression line slope, is flat and sideways. So it went from this period of an extreme steep upward move to a period of flat just in that window of time. And then it got negative and went to -2. So there was a period in here of almost 4 weeks that said, you can no longer count on this kind of gain being easily available. You better make sure that your stops are in place. Well, that continued to be a painful sell-off until just recently. And now that slope has gotten a little bit better because of this bump from 2 weeks ago. So instead of being just a rocket to the bottom or a falling anvil, we actually have a double bottom being put in. So now we are at a critical state. We're 1 standard deviation below the long-term average, so the slope of the 30 is still down, as you can see. But there's been enough price improvement here in the last 15 or 20 days to suggest that maybe that's over, that maybe we are looking at a double bottom. And so what this says is you can auto short this. If it fails below this doji's low from Thursday's low, if it fails below there, you must be short by that time. But be prepared for a potential reversion to the mean trade that's starting to form, and be very cautious about this because we are in bear volatile conditions, but the period of runaway bear market is no longer in effect until we see a price that goes below about 185 or 183, which is that swing low. So that's how you get insights out of that particular indicator. Now, that's fairly close to the idea that you asked me about the daily true range 30. That really is just the size of the daily ranges. In my view, the slope of the 30-period regression line is much more important in terms of picking market direction as opposed to the size of the true range. The true range can help, but I feel like the ATR percentage is actually more sensitive to a change in volatility dynamics than a 30-period average range because it's using a smaller sampling size. And so when that volatility enters or when it exits, it's going to be a lot more responsive. So that would be my my complex answer to that question. Is that clear to you, Dave? Yeah, Robert points out the 50-day ATR is a LeBeau metric, and I think that goes back to his preference to have longer holding times in his swing trade. So he's looking for, I think, more stable, longer-term trends. My sensitivity to changes in the trading regime make me more sensitive to shorter-term fluctuations. I just think with the number of algorithms that are out there, and with speed of execution and the increased algorithmic trading, that I'm not so sure that the studies from 20 and 30 and 40 years ago still have as much predictive power or useful power as they once did. I just think the nature of the trading, I think, is measurably different now than it was even 15, 10 years ago. So I tend to look for maybe the shorter term signals at smaller sampling periods so I can get an earlier warning, and then try to build positions in small increments, locking away gains and using market money to reward success and to protect my seed capital. So that's sort of my approach there. Dave asked me, let's see, looking to create a risk Z for other markets in countries that don't have a VIX. I tend to look at other countries. What I would suggest on that one is the Slopestat, because that will tell you when you get a volatility spike. And so volatility has the same kind of characteristics across different markets, and that is the normal condition is not the volatile one. The volatility represents a sudden shift in people's perceptions, and that's where you get that price, the price action difference. So the Slopestat changes relatively quickly and yet smoothly, and so it's actually a smooth system quality number. I would suggest if you look at there's a Slopestat, and then there's also the VolStat, the volatility statistic. And let me see if I can. I have that on the daily report as well. I use an ATR a statistic on the ATR percentage on the basis of 14 days rather than 30, and that's really the market classification strategy for volatility. It's 1/2 of that market volatility, and I would go with that before I would go with the 30-day average range, and only because the 14-day ATR percentage responds more quickly, and I think gives you earlier warning into changes in the market regime. Let me pull up that. Yeah, so here's an example this is on page 8, and you can compare a couple different ways to look at what I call the VolStat, or the volatility statistic. So chart number 6 is take the standard deviation of price over the last 30 days divided by price. So if you get sudden, sharp, large ranges, that makes the standard deviation get large very quickly, as opposed to the average. What you really want to think is to measure the standard deviation change. If you divide that by price, you get these rapid shifts in volatility regimes. So that's going to be very responsive. And then you can compare that over the same time frame over the last to look at the S&P, the ATR divided by price. This gives you ATR percentage, and then how that compares to the long-term average. And you can see that that's a little smoother than standard deviation divided by price. So either one of those, I think, is a good proxy for the risk Z. That's what I would use. One of those two will be useful for you for looking at things that don't have a VIX. And you can, I think, by looking at the direction of the slope, so like this one went up almost to 2 standard deviations and is now decaying. That's a sign of reduced volatility. And by the same token, you can actually see that the inverse of that here, that as the Slopestat improves, that's improving because the volatility is declining and the sell-off is less. So either one of those, I think, gives you what you need. You can see how smooth the decay was in the Slopestat, and that was mirrored by an increase in the VolStat. So there is a relationship there between volatility and price that's as clear as a bell. So that's what I propose to say about that. And I think, yeah, Jeremy's not on, but Jeremy, when you listen to this, in the TradeStation bundles, in bundle 2, we have that indicator built, so you can get that generated for thousands of symbols. You get the slope statistic, you get the volatility statistic. You also get what we call the alpha statistic, the alpha stat, where you compare the slope statistic of a symbol and subtract from it the S&P's slope statistic, so you get the residual relative strength of the instrument itself. It takes out the market's contribution to its slope, and what you're left with is how much alpha that thing is generating compared to the market. And then you can compare instruments on the basis of alpha, a very, very powerful tool. That's in bundle number 2 for those of you playing with TradeStation at home, which is very reasonably priced. And if you're within the sound of my voice, I'd be happy to give you a discount on that if you find that to be of interest. But on the virtue of suffering through this, the pilot program here for the swing trade workshop. So there we go. That's everything I wanted to cover tonight. I'll get the other videos uploaded, and I'll get this one produced and hung and then posted in Basecamp, so you could listen to the stuff again if you need to. So lots of work ahead. What you guys owe me by the end of this week is we'll make a corporate decision on whether or not we want to spend an extra week on the systems rather than pushing on into the strategies. Are these questions visible to others? I don't know. Can you see anybody else's questions? Or can you only see your own? Okay. I don't think there is a way to do that. However, well, actually, let me ask it to you this way. When you fill out the little question and answer thing, is there a toggle on there that lets you send it just to me? Okay. Okay. Well, the good news is, I guess you can. Oh, well, okay. Patrick says you can do that, so you might post that in there. You could also put it in the chat, and you might also. Well, I know that when I produce the video for the workshop, I know that it records those as well. Patrick, you asked me about. I see in the chat there, ETF2 notes. Question about the theoretical exposure in the model portfolio, and you asked me some technical questions about SQN. I'm going to defer the question on ETF2 and the SQN until we get to the strategy portion. I don't want to muddy the water until we get through the 6 swing systems per se. But if you will send me an email, I'll try to give you a preview of that. Also, Tim Clark is going to be in Kansas City on Wednesday night over at the hotel where we do the workshop at 7 o'clock, and we're going to have dinner and talk about some things. I think you might, if you're free on Wednesday night, want to come out and get some chow at Ruby Tuesdays, we might do that. So let me know. Yeah, oh yeah. I mentioned that a little bit earlier, but I would just say, guys, let's use the communications on the message boards in Basecamp rather than through the use of email, because the message boards gives everybody the ability to see the thread. It lets us do threaded discussions and keep all the comments together rather than playing email tag. This gives you don't have to think about, well, who has seen it, who hasn't seen it. Let's really want us to use the that message thread to do our coordinations. Lisa, I would ask you to look at the. I'm thinking that working with Tim and Terry for partnering would be a good thing. I've asked Stan to work directly with me, so I think you're ready to work with Tim and Terry. So if you can kind of shift fires to them, they'll work with you there. And then Stan, that gives you and I a chance to work at a more deliberate pace on specific questions we have. I have a slightly different approach in mind for you that I'll talk with you about through email. All right, so Patrick, I owe you answers on ETF2 when we get to there, and I'll send you some background material on it. In a nutshell, since you did ask, the easiest one to answer I can just do right now is the theoretical exposure in the model portfolio. So the theoretical exposure simply says, given the conditions of the market, the 10 primary indexes, each one of those controls about 10% of asset allocation. So if they're all above their 4-month moving average, the asset allocation model suggests you could be 100% exposed without any troubles. Go ahead and you can add new money into new positions up to that level. Once we take positions, then the controlling factor on that one is the stop for each one of those symbols. So as it stands right now, we've got 7 positions in the market, so we're 70% exposed, but the theoretical asset allocation is at 0%. What that means is I can't add any new positions because I'm already over that threshold. But I don't use that to exit any of those positions because I have a stop in place that protects me. And the positions that are in there are ones that are more likely to do well in these choppy markets or the bear market, or even if the bear market is over and starts to resume, the positions that are in are well postured to succeed. So it sort of acts as a governor on when I can add new money, but it does not act, I don't get out of the market on general principles if I have a stop in place on that swing system. So I'll send you some background info on that. Okay. Yeah, ETF2 is a pilot signal. Yeah, correct, Robert. All right, guys, that's everything I proposed to talk about tonight. We've got a busy week ahead of us, and we will see you in the message boards and in the chat room. And Terry, make sure you make contact with Lisa and vice versa, and get Tim reeled in. I think he's traveling tonight. So we'll take. I'll see you in the room and in the week ahead. Take good care, guys.